There's an alignment of the markets at the moment. It's quite an unusual event as well, all to move in the same direction. That is equities, bonds, and commodities. That is, of course, apart from oil, which has been an outperformer pretty much since the beginning of the year. Why? And can it sustain that direction, or will it have to realign with the rest of the markets? Well, joining us now is Dhaval Joshi, Chief Strategist at BCA Research, following up on a recent paper of his which indicates potentially we could have some downside to the price of oil. Dhaval, it's good to catch up with you again. First of all, this alignment, how unusual is it?
It's incredibly unusual. So we looked at the last 200 calendar quarters, that's 50 years. And it's only happened once before. So this big sell-off we've had in the second quarter, where everything sold off essentially, whether stocks, bonds, inflation-protected bonds, commodities, industrial commodities, metals, and gold. Gold also sold off, right? So those five things selling off together last happened in 1981. So we're talking about a once in a generation event. I call it a 1 in 100 event because we've had 200 quarters, right? 200 calendar quarters. This is only the second quarter that's ever happened before. So it is a sort of 2 out of 200 is 1 in 100 event.
What's behind this then? I mean, I'm tempted to say it's all something to do with the war in Ukraine, but is that all it is?
No, it's more than that, because we've got this situation which last happened in 1981, where you have inflation fears, very severe inflation fears, which are being attacked with gusto by central banks. So I'm sort of saying that, in a sense, what we could say is the Jay Powell Fed is like the Paul Volcker Fed of 1981. And then what happens is you get inflation fears, they suddenly sort of morph to stagflation fears, and eventually they morph to recession fears. And when that happens, nothing escapes. Pretty much nothing escapes apart from so far oil, as you alluded to at the start. That's really the connection. There's a remarkable sort of star alignment between 2022 and 1981.
Well, let's look at that point about oil and what's keeping it up. I'm hearing a lot of concerns about the fact that there's insufficient supply coming through, insufficient investment coming through in terms of some of these large oil companies. What are your thoughts on why oil is as high as it is?
Well, again, we have a remarkable similarity between the early 80s and what was happening right now. So we have these sort of inflation fears in the background already, and then suddenly you have a war between two major commodity producers. As it happens, it's a remarkable similarity again. They're neighbors. In 1980, 81, it was Iraq invaded Iran. They're neighboring countries. It was a sort of politically based full-scale invasion, and they're both commodity producers. Fast forward to 2022, and it's Russia invading Ukraine. A very analogous situation, and in both situations, again remarkably, on the day of the invasion, or just after the invasion, the price surged by 25%, both in end of 1980 and, of course, in February of this year, 2022, because of supply concerns. Because a tight market, and you're taking out supply. Exactly the same happened in, as I say, 1980, 81. So the initial reaction of oil is up when everything else is coming down, but that doesn't last for very long. Because if we look at what happened in the subsequent months of 1981, as the economy started slowing, oil lost its sort of momentum over the sort of subsequent part of 1981.
So what's the relationship between recession, for example, and where the oil price goes? There are certainly some people penciling in recessions for some of the economies around the world because of the way that central banks are trying to stem inflation. So a recession could well be the likely outcome. To what degree does that have an effect on the price of oil?
Well, put it this way, I'm going to put it very simply. There has never been a recession or even sharp slowdown in living memory where the oil price has not collapsed. So, even in 1980, 81, after Iraq invaded Iran, the price did go up. But as the recession took hold, the drawdown, even in that period, was 25% from the peak. And then you go through every other recession or even slowdown, as in the dot-com bust or the sort of EM recession, which didn't really hit the US or the UK in 2015. Oil prices collapsed. I mean, they were down about 60% in that particular case. Yeah, so you can go back through the last 7 recessions and you get a collapse every single time. I don't think this time is any different. I think those are the foremost dangerous words in investment. This time is different. I just don't believe that is the case.
So what's the playbook then to follow? As you say, oil will play catch up with this market drop if that's what does happen. What should we be doing to position ourselves to benefit for this?
Well, I mean, I say we have a sort of range of outcomes. If it's a sort of if those supply concerns, we know that story that the market is very tight, no investment in oil extraction or fossil fuel extraction, all that sort of stuff. A lot of pressure from ESG saying that we really want to kill this industry. We know those stories. Nevertheless, what happens is in a recession, the demand side dominates. It overwhelms any tightness of supply. So we have a range of outcomes. If it's if supply remains tight, as it did in 80-81, the price drops to around $85 from where we are now. That's kind of the best case. The worst case is a kind of pandemic situation. That we tend to have short memories. Remember what happened 2 years ago? The price went to basically, WTI went into negative territory. Brent went to about $20, if you remember. That was only 2 years ago. So that's the sort of worst case where you get to around 30, 35. I know these sounds like shocking numbers, but that's what happens in a recession. The middle case is around 55, 60. That's the median outcome in a recession.
So what's the keen trading positioning here? Presumably short oil.
Yeah, and I think if you want to sort of hedge your position, and you say, well, I don't want to go all out in that position. One other way of doing it is to short oil versus copper or an industrial metal. Because if you look at what's happened, copper's already down 20-25%. Tin is down 40%, 45% from its peak. So what you can do is just short oil versus copper. By the way, that ratio, oil to copper, is at the top of its 25-year trading range. So that's another sort of reason why that could be a good trade. And in stock markets, obviously, be wary of oil and gas equities. I would sort of be underweighting them versus industrials, basic resources, and banks. And oil-heavy equity markets like Norway obviously will underperform because they are really heavily leveraged to what's happening in the oil market.
Very quickly, one final question. How quickly is this likely to happen? Once it starts moving, is it a very quick trip down to the average of 55 by the end of the year? Do you have a sort of a rough sort of period in mind?
Yeah, I mean, so this should, within the, I mean, I don't think it's not necessarily imminent. I mean, I would sort of I would say it's more of a sort of 6 to 12 month story, because it all depends on, how fast we get into recession, if we do, and how severe it is. So there's other parts of the equation. Are central banks going to cave in? At what stage do they sort of run out of courage in their hawkishness, etc., etc. So I'm not saying this is a sort of imminent trade, but it's certainly something that should work on a 6 to 12 month horizon.
Look, it's a pleasure to catch up with you again. Thanks indeed for your time. Interesting story, and looking to see how all this plays out. Dhaval, in the meantime, thanks for joining us. Dhaval Joshi, Chief Strategist at BCA Research.